If we put all the silver that's been purchased on one side of the 50-yard line, and we put all the paper that shows ownership on the other side, the mismatch would be huge. Would it be double, triple, quadruple? Would it be 100 times? I don't know that number. What I do know is that if everyone that owns silver actually put it on their front porch or out in their field or whatever, it doesn't match.
Recent scrutiny in the silver market has raised concerns about the divergence between physical and paper ownership of the precious metal. DavidMorgan, renowned as the founder of the Morgan Report, has emphasized the underlying risks associated with this discrepancy, shedding light on a potential historical market cornering that took place 2 decades ago. With the silver supply having risen from 550 million ounces to approximately 800 to 850 million ounces, the market is grappling with the consequences of these fluctuations. Notably, the supply of silver has demonstrated relative stability compared to the previous year. However, the demand for physical silver has witnessed an unprecedented surge, leading to a significant deficit. Last year's deficit of merely 50 million ounces has skyrocketed to an alarming 237 million ounces, signaling an apparent shortage of 7,393 tons when contrasting demand with available supply. Morgan's observations draw attention to Morgan Stanley, a prominent financial institution under scrutiny for its approach to silver ownership. The firm revealed a need for more silver acquisition and a notable absence of proper storage facilities, instead relying on issuing paper representations to its clientele. Morgan Stanley agreed to pay $4.4 million to settle a class action lawsuit involving brokerage clients who purchased precious metals and paid storage fees. The lawsuit highlighted the case of Silver Blatt, a Maine resident at the time of filing, who had purchased silver bars from Morgan Stanley during the period under investigation. DavidMorgan contends that such instances suggest that the accumulation of silver purchases could feasibly drive prices higher, as the price tends to act as the arbitrator between supply and demand dynamics in the market. Join us as we delve into insights shared by DavidMorgan. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
I just wanted to give that background. So the deficit went down from 2 billion ounces during the Hunt brothers down to 500 million ounces in about 2005. The inventory has actually been building since then, but it is starting to offtake rapidly due to 55% going into industrial supply or use. It used to be 35% 20 years ago. So that's increased 20% or hasn't doubled, but almost in 2 decades. And yet the silver supply has increased from 20 years ago, 550 million ounces to 850 million ounces. So in other words, it's almost doubled in use during the same time that the supply was increasing. Now, the supply has remained around the 800 million mark for a long time, 15 years. That's a long time to me, in a person's lifetime. So what it's going to take is the truth. And here's the truth, the way I see it. Now, can I prove this? I could prove it if we could accomplish what I'm about to say. The silver market was probably cornered 20 years ago. And I was going to make this my speech at the Silver Symposium in Las Vegas. Unfortunately, I wasn't able to get there. If you took all the people that own silver or think they own silver, and you compared that to the actual physical metal that exists, there's a huge mismatch because it's been hypothecated and rehypothecated. I'll give you a few examples. It's something I've put up on my Twitter, or maybe I'll do it after this interview if I could find it again. But Morgan Stanley settled a lawsuit because one of their bigger investors was buying silver through them and storing it with them for quite some time. And somehow or other, he got wind of the fact that maybe his broker wouldn't let him see his own silver or, see the vault or whatever. Turned out that Morgan Stanley never bought any silver, and they didn't even have a vault. But during the discovery process and into the court record, to the best of my knowledge, defense for Morgan Stanley was that it was standard practice in the industry to do this. In other words, it was standard practice to give your client a piece of paper that showed what their silver purchase was and it was being stored when they had never bought any silver. Maybe they didn't even have a storage facility. Now, if that doesn't send chills up and down your spine as a big silver investor, I don't know what will. So my point is that we probably bought enough silver to actually take the price higher because price is the arbitrator of supply and demand. So in the Morgan Stanley occurrence, They just made everybody whole by paying them the paper price of silver or what they paid for the silver, which is radically wrong because people buy silver to be out of the banking system, or at least to hedge it. You might have a bank account, but you've got 5% of your net worth in silver. So they should settle in silver. I mean, that would make it right? All animals are equal, right? Same rules, laws, and accountability. I bought silver, give me the silver. We had one with a major depository that was used a lot of IRA money. That was gold deposits and silver deposits for their IRAs. And guess what? They didn't have all the gold and silver that was there. I put that on my Twitter account as well. This is much more pervasive than you think.
Experts argue that the federal government's actions to support Silicon Valley Bank's depositors can be unequivocally labeled as a bailout in the realm of government bank bailouts. Neil Barofsky, former overseer of the Troubled Asset Relief Program, a sweeping bailout initiative that rescued the banking industry during the 2008 financial crisis. If your definition is government intervention to prevent private losses, then this is certainly a bailout. Highlighting the unpredictability of the financial system, Morgan emphasizes the uncertainty surrounding potential bailouts. He cautions against assuming equal treatment and accountability in today's society, shedding light on the complexities inherent in such interventions. Morgan also challenges the prevailing notion that United States Treasuries are the safest investment, exposing what he perceives as a fallacy in the system's reliance on U.S. debt. With the escalating challenge of repaying both the principal and interest, he underscores the need for a critical reevaluation. Let's get back to the interview.
And this is today's world. There's justice for all, except some are more just than others, going back to Animal Farm. So if it's going to take out some of the major players in Silicon Valley, well, we won't bail in like we say we have to. We'll break the law and we'll bail them out. And what I said about that was, does that prove me wrong? And I said, no, actually, I think it proves me more correct from the aspect of today's world, which means you don't know what they're going to do. So the next bank that fails, maybe it's just a bunch of small farmers in the Midwest and a bunch of real estate developers and then the townspeople therein, and they bail everybody in because they're inconsistent. When the country was founded, it was the same rules, laws, and accountability for everyone. Dunnigan stole a crate of oranges from the local grocer. Mayor of the town did the same thing. The punishment would be identical because it's the same rules, laws, and accountability. So you were accountable, and then the judge always put you in jail for 2 months or whatever. But that's not the case anymore. I'm making the point maybe too strong, but I think people need to know this. And it's like, well, they're going to bail everybody out. You do not know that. In fact, I would argue it's probably more likely that they will cherry pick their friends to bail out and the rest of us get bailed in. So bear that in mind. The other point is, how stable is the banking system? Well, it's broken. It's been broken for a long time. If 5% of the depositors at any given time came to their bank and said, I want my cash, the whole system would collapse. So if you've got, whatever, 5,000 in the bank and you want to withdraw 250, and everybody that has whatever amount their deposit is, or the deposit, because it's their money, came to the bank and withdrew what they consider their deposit, 5%, take the bank down. Most people just keep it in the bank, and then it's in their bank transaction. It goes from one bank to another bank to another bank. And that's the way the system is set up, and it works. And the likelihood of a bank run isn't very likely, but it's not improbable. And it is a possibility. And especially with what happened in the 2008 financial crisis. You remember Senator, and it starts with a K, I can't pronounce his name very well, but he talked about an electronic run on the banks, that so many billions of dollars were flooding in that the Fed had to step in and do something. Well, that's the case again, only it's been a slightly slower process where many depositors have moved out of the bank and into money market funds. So the deposit base is a lot less in the banking system itself. So that puts greater stress. But the greatest stress is the way the system is set up. And the way the system is set up is the idea that the safest investment on the planet is in the United States Treasuries or U.S. debt. And this is an absolute fallacy because right now it's impossible to pay back that debt. And it's getting to the point where it's almost impossible to pay back the interest on that debt. And because of that fact, you have a very unstable system. But above and beyond that, as we all know, or anyone that follows me or you has learned or knew already, that when interest rates go up, bond prices go down. So right now, the whole basis of the system is based on the United States dollar and the short, intermediate, and long term.
Metals Focus, the firm behind the research, noted that the deficits in 2021 and 2022 have more than offset the cumulative surpluses of the previous 11 years. The Silver Institute and Metals Focus expect silver to post another sizable deficit, even if it is down from last year's record highs. Analysts expect solid demand will create a market deficit of 142.1 million ounces in 2023. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.